Hello everyone. Moving on to equity. One of the most crucial elements of our business will be the topic of discussion of this video as well as other forthcoming videos. So let's begin with understanding the basic. What is equity? Equity simply means business. And when we invest in equity, it means we are buying a part of this business. So when we buy shares of TCS or HDFC or SBI or Mahindra and Mahindra and various other big and small names. So what are we actually doing? We are buying a part of these businesses. And what do these businesses do? These businesses invest money to generate profits. And where do these businesses get this money from to invest? So if it is a small business, then the promoter may put in his own savings. But when this business grows and needs more and more money, then the promoter's savings may not be sufficient. Then the business has to source money from outside. Now there are two options available to a business for sourcing money from outside, through debt and through equity. Under debt, the business will borrow money, pay a fixed interest and repay the money to the lender after a specific period of time. Under equity, the business can source capital from the investors by issuing them shares. These shareholders become the owners of the company to the extent of their capital contribution. And they are also entitled to a share of profits or losses in the business. Now let's take an example for understanding this better. So there is an investor X and X buys a 9% L&T bond. This bond has a maturity of, let's say, 15 years. This is a debt situation. L&T, the business, is borrowing money from X at 9% fixed interest rate by issuing a bond for 15 years. Now there's another investor, investor Y. Y also invests in L&T, but he takes the equity route. So Y buys shares of L&T. So why do you think that X chose the bond route while Y went for the equity option? This is because X is looking for stability in his investment. He will get his fixed interest of 9% and will get his money back along with the interest after 15 years. While Y want to participate in and benefit from the growth of L&T's business. Let's say both the investors invested Rs 10,000 on 1st April 2003. On the investment date, the share price of L&T Limited was Rs 26.04. Now both these investors withdrew their investment after 15 years. The value of X's investment at 9% interest per annum was Rs 36,425. Coming to Y's investment, L&T's share price over these years grew from about Rs 26 to around Rs 1311, registering a CAGR growth of a whopping 29.86%. And what happened to Y's investment? Y's investment grew from Rs 10,000 to Rs 5,03,417 over the same period of 15 years. That is almost 14 times of X's investment value. An important point to note here is this 30% return did not come in a straight line. There have been ups and downs. In 2003, even Y did not know that L&T would do good. But he placed trust in the company's management and created wealth for himself. So here, what you need to explain to the investor is that when L&T is borrowing money from you at 9%, it will make sense for L&T to borrow at this cost only when it is able to make more than the cost. Else, how will it be able to service the debt and repay to the bondholders? In this case, L&T made around 20% over and above the cost. So when you have the option of making 30% on your investment by investing in shares of L&T, so why do you want to settle down at 9% by investing in L&T's bond? Also, An investor would invest in L&T's bond because he knows he will get his money back as L&T is a stable company. So you need to tell these investors that why not invest in the stable company's business and make more money. And lastly, what the investor needs to know is a lot of time, money, efforts, and immense brainstorming goes into doing a business and getting these astounding return numbers. So when an investor invests in shares of a company, he gets to experience the thrill but without undergoing the hassles of doing a business. The management and employees of the company put in all these efforts while the investor can relax at home and reap the fruits. So, by investing in shares of L&T, the investor is utilizing the wisdom of smart people who are running a business like L&T and making money for the investor. So, the bottom line is equity means owning the business. And you may buy equity by buying shares of the company. As a shareholder, you're entitled to the profits of the company in the form of dividends and capital appreciation from the share price movements. And the share prices may go up or down depending upon the performance of the company. So now the investor knows what is equity and why should he invest in a business via equity. So the investor will invest in the business by buying its shares from the market at the current price of the share. And our next topic of discussion is how do we arrive at this price?